It tells us what Alex's utility function is. It tells us what his initial wealth is. It tells us the chances that he may lose some money, and it tells us how many customers there are in the industry. Each question that's like this is going to give us a lot of the same information. So we need to look at the question first to see what we're actually going to be answering. The first question says, the certainty equivalent of Alex's gamble is blank. Well, remember, the certainty equivalent is the single amount of wealth that Alex would accept in exchange for his gamble. So his gamble was a 20% chance of ending up with $50 because he's losing $50 and he started with $100. And it's an 80% chance of keeping all $100. So that's his gamble. Well, the certainty equivalent is a single amount of wealth that he would accept right now and not have to take any of those risks. So when we're talking about something that he would be willing to accept, we need to look at his utility function. So in finding the certainty equivalent, we're going to bring in that utility function. On the left side, we're going to have 20 over 20 plus the certainty equivalent, where that certainty equivalent again is an amount of wealth, it is an amount of W. And we notice on the left side, it's with 100% certainty. So there's no chances of each thing happening. It's just 1 multiplied by that whole thing. On the right side, we have his gamble. We have an 80% chance that he's going to end up with 100, so we plug in 100 to his utility function. And we have a 20% chance he's going to end up with 50 because he'll lose 50. So we plug in 50 to his utility function. From here, we're just going to do a bunch of math. We're going to crunch out these numbers and combine like terms. So from here, we can combine like terms on the right side. Now we're ready to multiply each side by 20 plus CE, which will take it out of the bottom on the left side, and we'll just have 20 on the left side. On the right side, we'll multiply that through. Now we can subtract 3.8 roughly from each side and divide through by 0.1904762. And we find that his certainty equivalent is 84.999 repeating, or his certainty equivalent is 85. The next question says, the price of the insurance policy is blank. Well, since it says that the insurance industry is perfectly competitive, we know that each firm is setting price equal to marginal cost. Therefore, each firm is not making an economic profit. They will set the price of the policy equal to the expected losses plus any administrative and transaction cost. And it defined that in the problem. It gave it to us. So the cost of the policy, again, is expected losses plus any administrative and transaction cost. Well, expected losses is how much did we start with, our initial wealth, minus how much we expect to have, which is our expected wealth. And in this case, we can find expected wealth is just 0.8 times 100 plus 0.2 times 50, or 90. So we started with 100, we're expected to end up with 90, therefore our expected losses is $10. So the cost of the policy is that $10 of expected losses plus the $1 administration cost that they gave us in the question, or the cost of the policy in this case is $11. The last question says, the value created by the insurance industry is blank. Well, the value created is equal to the most that drivers would be willing to pay for insurance minus the cost of insurance, or the price they actually pay for insurance, times the number of customers in the market. The most they would pay, we find that by looking at their certainty equivalent, because we know that if they're willing to accept, we found the certainty equivalent was $85. So they're willing to accept $85 right now and not take any risk at all. That was based on their preferences and their utility function. So if they have $100 today, and they have to take these risks, and they're willing to accept $85 for a certain situation where they don't have to take any risks, the most they'd be willing to pay for insurance is the difference of those two things. In this case, the most they'd be willing to pay for insurance is $15. What do they actually have to pay? Well, we solved for that. That was the price of insurance. That was $11. So the value created is that 15 minus 11, so $4 per person times how many people there are in the industry. In this case, there's 10,000 identical people, so the value created by insurance is $40,000.